Good afternoon, ladies and gentlemen, and thank you for joining our Healthcare Real Estate Value Proposition webinar, where we hope to share our insights with you on the healthcare opportunities in Africa, a sector that you will agree with me has been of increasing interest during this period. My name is Tilda Mwai. I am the researcher for Africa, and I will be your host for today's webinar. And I'm joined today by my colleague Jamal, who is our partner in charge of healthcare and education in Knight Frank Middle East and Africa, and Martin Fitchet, our head of valuation, our director of valuations in Knight Frank South Africa. For housekeeping purposes, in terms of the running order, our webinar will run for 1 hour, where Martin and Shazad will share their presentation. And then after that, we will have a Q&A session. To address all your questions to the best of our ability, we have the country heads from all the Knight Frank offices dialed in, and they will handle all the specific country-specific questions that you may have. So please keep your questions coming in. You can submit your questions throughout the course of the webinar using the Q&A tab at the bottom of your screen that you can find over there. To also keep you engaged throughout the webinar, we will be running a poll. And so sometimes the poll might disrupt your view of the slides. So to assist you in that, once you have answered the polls, just ensure you minimize the poll tab so that you can continue seeing the slide presentation. Now, before I hand over to Shazad, I'd like to tell you a little bit about Knight Frank, and in specific Knight Frank in Africa. So Knight Frank is a global real estate company. We are the largest independent consultancy firm for real estate. And in Africa, our presence is in 21 offices across 10 countries with a membership of 498 employees. Over the past 12 months, we have worked in 49 out of 54 African countries, and our range of services moves from valuation to property management, residential consulting, occupier services, hospitality and leisure, agriculture and advisory, healthcare and education consulting, and also Africa research. So Africa Research, Africa Research is a bespoke service to support our other service lines. And as you might be aware, we have our flagship publications, which include the Africa Report, Africa Horizons, and more recently, our Healthcare in Africa report. And by that, I'm going to hand over to Shazad.
Good afternoon, and thank you very much for the introduction. So I'm Shazad. I head the healthcare and education practice for the Middle East and North Africa region. By my background, I'm a chartered accountant, been with a big four firm for the last 10 years, and I moved to the region 7 years ago. Have in the last 7 years been more focused towards the healthcare education space, as well as a bit of real estate. In terms of jurisdictions that I've worked on, they include Indonesia, the United Kingdom. We've got Tunisia, Egypt, Egypt, a lot of the GCC, the Levant region, and even Tanzania. So that's my introduction. I leave the floor for Martin to introduce himself.
Thank you, Shazad. So I'm based here in South Africa, working between Johannesburg and Durban. I've been a valuer in South Africa for the past 30 years, currently registered valuer with RICS and FIVSA, working largely into the listed sector on AFS portfolios, and then outside of that on a number of specialized subsectors, including the energy and education and health sectors, subsectors. So yeah, I'll be looking at later in the slideshow issues around yields and some case studies in South Africa.
So the healthcare practice is quite new to Knight Frank. For the region, we started in 2018. We've got members from the medical fraternity. We've got corporate finance professionals. We've got real estate professionals that make up our team and provide services around the region. Since 2018, we've advised and valued projects in excess of about $1.1 billion across KSA and UAE. In terms of the sort of research that we put out, the first research that you can see is the healthcare guide that was developed and is now part of the Dubai government strategy and healthcare authority strategy when they're looking at introducing healthcare investments in the country. We've done 2 reports on Saudi Arabia and 2 reports on the African region. In terms of services, what we look at is we provide feasibility studies, we do a bit of commercial due diligence, market demand studies, and operator search and selections, as well as valuation, which is the core subject of this presentation. In terms of the agenda that we'll be covering today, we'll be discussing COVID-19, a little bit on that. We're talking about healthcare opportunities in Africa. This is a reflection of our Africa report that we issued recently. And then we'll move on to the healthcare real estate valuation, followed by the Q&A as advised by Tilda. Within the COVID-19 space, we'll just give a general overview. We talk about COVID preparedness and impact on global real estate as a whole. When we look at it on a global perspective, the data as of yesterday that we've been able to source, we see that in the world there were about 7.8 million confirmed cases, and the average day-on-day growth rate was about 1.72% in the last 1 week. In terms of key facts and good news, New Zealand was declared COVID-19 free on 8th of June 2020, and schools have commenced in the Netherlands in the beginning of May. When we look at the African continent, we see that there are over 182,000 confirmed cases, with which is about 2.3% of the global cases, and the day-on-day growth rate has been about 3.7%, which is a bit higher than what the world in general has been achieving. But let's not forget, COVID has reached Africa a lot later than the rest of the world, and a bit of some of the countries are now in their second wave. In terms of preparedness, one good measure to look at preparedness for healthcare and COVID is, the amount of screenings that have taken place per 100,000 population. In doing that, we see that Italy has done about 3,715 cases per 100,000 population, while the UK has done close to 1,500 cases. South Africa has done about 580 cases per 100,000 population, while the rest of the African nations are below 100. However, we need to look at the positive aspects that because of the previous pandemic experience, Africa was more ready than the rest of the world in terms of having a successful contract tracing method. They had public financing agreements with private hospitals in case of surge and demand, which have been taken care of. And there's always this continuous awareness and surveillance bit that has been carrying on that will help ensure contain this pandemic as much as possible. In terms of the other part is about infrastructure for COVID-19, and ICU beds and ventilators are a key metric over here. We can see that compared to developed countries, the ICU bed density is low. The map on the right illustrates the ICU bed density for us, where we see that the countries in dark gray have between 1 and 3 beds per 100,000 population, while the countries in light blue have greater than 10 beds per 1,000 population. What we need to take away from this is a quantum of opportunity that's available for the private sector to invest in healthcare within the continent itself. Now, how has this played out in terms of valuation shifts? So from a global perspective, what we see I mean, we looked at Singapore, we looked at Hong Kong, we looked at the UK and mainland Europe. We see that between Jan and May, a lot of the valuation, I mean, the valuation has been in the negative territory between 5 and 10%. In Singapore, the case was the case was so severe that the government had to give rebates to the landlords, which had to be then moved on to the tenants in order to help ensure continuity of the retail business. If we look at Hong Kong, the only end that went up, had an upward shift, was was the logistics sector. It's because of the online business, which required a lot more, let's just say, warehousing facilities, which is why there was an upward shift. For Africa, I'd ask Martin to shed some light.
Thanks, Shazad. I think we're finding it's still rather early days for any hard data to come through on post-COVID yields. I'm realizing that Africa, with a younger population, for one thing, is still moving towards peaking in certain environments, such as South Africa. But essentially, it's too early for us to measure the impact on the property yields. I think what we're seeing up till now is measures taken to bring relief through the cash flows to the tenants, particularly the retail sector in South Africa has been very proactive in grouping together with the South African Council of Shopping Centres, SAPOA, and others, with guidelines for that. So for now, the impact of 2 to 3 months rent relief on values running at pre-COVID yields, even with a slight upward shift in the yields because of the pre-COVID economics, is probably around 0.25% to 0.5%. We expect this to rise in the next few months, particularly in the hospitality sectors and the retail. It'll take several months before we're seeing any analytics coming through on the office and other sectors. For now, though, logistics appears to be stable in demand, and residential marginally down simply because there's been a slowdown in transaction volumes. Back to you, Shazad.
So we'll be discussing the key topics that we covered in our healthcare opportunities in Africa report. We'll be discussing demand drivers, key challenges and opportunities, interview sessions with what the experts had to share with us on the sector. We got value proposition for an urban development as part of this segment. So to start, when we talk about changing demographics, we see that the population is expected to reach about 1.6 billion by 2035 from the current 1.3 billion. And the population over 40 is to be increasing by about 1.7 times. Having said that, we will still be classified as a young population because 60% of the population will be below the age of 30. However, what we need to understand is that the population over the age of 40 will have a lot of lifestyle diseases, and the people over the age of 60 have a higher propensity to use healthcare services. So with such a surge in this population ambit over here, there will be a lot more strain on the healthcare services within each country. And of course, I mean, whilst the population is growing, we see close to 188 million people or new births, 188 million new births from now to 2035, which would mean that, of course, there will be great demand for the mother and child segment, the chronic disease segment, and of course the long-term care segment. When the other growth factor that we need to consider is urbanization. As of now, 40% of the people are living within the urban setting, and by 2050, we see that increasing by about 50 to 60%. This effectively is 11 times the size of Europe, and with population concentration within the cities, is going to strain the healthcare services within the sector, which is why we need a lot of concentration in this ambit, in this section. Previously, when we talk about increasing disease burden, previously we saw that Africa had only communicable diseases that was a worry. But now, I mean, as per the current data, about 2.8 million people between the age of 20 and 79 are faced with diabetes or are diabetic. And there's an increase in demand for specialist healthcare services coming in, especially because now, due to the urban setting, increasing middle class, there's a lot of sedentary lifestyle, consumption of processed foods, which is causing this issue. And because of this burden, and also increasing middle class, I'm going to refer to later. I mean, just for an example, to put everything into perspective, Nigeria loses approximately $1 billion just to medical tourism. I had discussed about the middle class segment earlier, but like the African Development Bank estimates that the current middle class will increase from about 355 million people to about 1 billion people by 2050. Currently, there are about 12.8 million people with income levels over 20,000 per annum. And the rising middle class would then have demand for and require quality care and also preventive care. This is another area that we will need to focus on. In terms of health infrastructure deficiency, or the density as we call it, we see that that the average world ratio sits at about 2.7 beds per 1,000 population. So this average includes the OECD countries, the most developed countries and the most undeveloped countries, and we're sitting at an average. And if we use that as a matrix just to understand the quantum of beds required, we would see that Nigeria would require close to 386,000 beds, whilst Kenya would be looking at about 70,000 beds. It's important to note that South Africa's bed density is slightly higher than the world average, which is why we've not put the data in there. But in terms of quantum of investment, Nigeria would need about $82 billion in terms of just $11 billion. If we, however, look at it based on their current ratio of bed density to meet the requirement, to just maintain this between last year and this year, an investment of about $1.9 billion will be required across the continent. Excuse me. Third aspect is the technological advancement. When we talk about technological advancement, we're talking about big data, we're talking about telemedicine, we're talking about teleradiology and online dispensary. Telemedicine historically was used to access remote areas, but now it's trying to make it into more mainstream thanks to COVID as well. And insurance companies have now picked this up and have now allowed for its use. For a good example is Mwai in Kenya. They've started using telemedicine across the country. Then, as a result of all this, there'll be a change in demand for healthcare in general, and healthcare, for example, there will be a change in demand for hospitals and what their composition would be like. With a lot of telemedicine and a lot of teleradiology, the hospitals might probably shrink in size because we wouldn't need such large spaces. And probably with all this connectivity, instead of having larger 300-bed hospitals, we would need probably 50-bed hospitals, which are spread across the area so that there's more connectivity and connected to a larger hospital, or probably like 250-bed hospitals across in different parts of town and one central hospital. So effectively, we'll be able to have better reach and more accessibility. Key challenges, and another big metric for understanding a challenge is the type of health expenditure per capita that the countries are committing to. We see that the United States spends about $10,000 per capita, whilst the UAE is about $1,300 per capita. The African countries combined have an annual health financing deficit of close to $66 billion for primary care alone. And as per the Abuja Declaration of 2001, the countries are supposed to set aside about 15% of their GDP, whilst I think South Africa is only doing 8% and the rest of the countries are in less than 5%. However, we should also understand that the developed countries have an aging population. About 20% of the population is over the age of 65, while the countries that In Africa, we see that 82% of the population is less than 40 years old. So probably we don't need that sort of investment as these people, those countries are incurring. But what we definitely need to do is we need to invest more, because there is a clear shortage of services within all aspects of care that is required within the continent. What we have also done here is we've tried to map challenges with opportunities that we have. And what we see from all our interviews, we find that the biggest challenge in Africa is healthcare workforce retention, and which is why there is at times this dependency on expatriate workforce. And the thing is that because quality of care is not given, and this segment has been neglected a bit, there is lower remuneration packages. What this does is creates a lack of quality circle that carries on, and it's a circular loop and does not end. But what we need to understand here is that there is a growing middle class that we mentioned earlier, and that middle class would then want higher quality of services, and would also be willing to spend money on over the entire spectrum. So the opportunity that lies here is not only for medical facilities like centers of excellence, multidisciplinary hospitals, and wellness centers, but also for educational institutions, because that would stem the quality, the quality of care, all the way from having our own workforce, be able to provide quality care into the system. So the other angle is that people have talked about. The biggest challenge was this is an emerging sector for attracting capital. And what we see is that, there have been a lot of activity going forward. For example, IFC has put in about $115 million fund to activate this sector and to acquire assets across the continent. But what we also see is that, this still presents an opportunity as a first mover advantage to benefit from the long-term growth. The other critical thing is that, some countries have established themselves as medical tourism destinations, and they've started appearing on the medical tourist world map. For example, South Africa, we see that there is about 1 million medical tourists coming in per annum. Algeria is about 0.3 million, but primarily they're wellness driven. Tunisia is about 0.5 million. Egypt and Kenya, although data is not 100% there, but we still understand that there's a lot of people that are actually coming in there. This is testament that there is the right infrastructure, there is the right workforce there. All this sector needs is the right investment channeled in the right direction in terms of having good healthcare education and also quality care at mass level. This brings us to our next slide, in which what experts had to say. What we did was that we spoke with private equity funds, we spoke with REIT operators, we spoke with investment banks, medical tourist operators, and so on, and asked them a lot of questions. But the three key questions that we asked them was, are healthcare REITs a viable investment option in Africa? What is the investment criteria of choice? And what makes healthcare investments attractive? So the answer to the first one was that, it's a viable investment opportunity for sure. It's low risk and it's long-term in nature, which is very good for REITs and real estate funds. Although I understand that certain countries are not, don't have the required regulations for REITs, especially for healthcare, but there's a lot of private fund options that can also be utilized for this sort of investment. In terms of criteria, they're looking at established assets as their first option, but they also say that probably there might not be enough investment grade options for this. So their second option would be probably having an established operator on a new build facility. In terms of investment attractiveness, I like it because it's a defensible asset. It's got these are triple net, just as good as a bond once the operator is up and running. And there's sustainable demand, especially with the way the population is growing, with the increased penetration of insurance, and of course the demand for private health care that is growing because of the middle class population. And again, we need to remember that because of COVID, a lot of the richer segment who used to fly at whim to different countries for care now cannot do so, and they will also be now looking at care within their home country. They'll be forced to look at that. In terms of investment activity, there's been PPP, there's been consolidation initiatives and financing initiatives. In terms of PPP, I think a good example was the Kenyatta National Referral Hospital in October 2019 for 300 beds. And there's consolidation with Evercare Fund, which bought the Avenue Hospital and the Nairobi Women's Hospital. And the IFC example I already shared with you. When we look at this from an urban perspective, healthcare from an urban perspective, what we see is in a general typical context from urban development point of view, we find that, there's residential, retail, F&B, that equals a certain footfall of people and also the certain spending power and demand for each of these services. But what happens when we bring healthcare into the equation? When we do that, what we see is, just putting in a 100-bed hospital, if there's demand in that area, that is, if we put a 100-bed hospital, that creates about 600 additional jobs and a daily footfall increase of about 1,400 visitors per day in that particular area. 600 jobs means that there'll be knock-on effect on the residential demand. It will help create egalitarian neighborhoods, which will again create more life to the neighborhoods itself. And 1,400 visitors coming day in and day out will also have a knock-on effect on the F&B and the retail segment. Then from a case in point, from the South African perspective, Martin will explain how the private healthcare sector has contributed towards the economy.
I think just to get some better perspective on the contributions, the drivers here for private healthcare obviously been access to private health facilities through private insurance, medical insurance, pretty much over the last 20-25 years. And obviously it's grown in scale. Today we're sitting with a population of 59 million. We have 225 private sector hospitals offering some 41,000 hospital licensed beds, held mainly by 3 listed groups: Life Healthcare, Mediclinic, and Netcare. And then in 2019, we had a newcomer on the block, RH Papello, with 8 hospitals, adding about 663 beds. We also have, in South Africa, the first unlisted healthcare fund through Growthpoint Healthcare Property Holdings, which includes 4 hospitals, plus a new pipeline development in Pretoria, which is a head and neck, the Sinto Care Spinal Hospital in Pretoria. And it's also Africa's first Green Star rating facility for a healthcare property. That's a 510 million rand development with 160 bed capacity, going to be complete this year. So with that backdrop, if we look at the data which was prepared for the Hospital Association of South Africa, this goes back to October 2017, across various sectors, the private healthcare industry adds significantly to the economy. If you consider that the capital stock to the value of 8.4 billion is equivalent to some 1.8% of all capital stock in South Africa. And that contributes some $0.9 billion from private hospital groups to the national economy, equivalent to 1.3% of GDP. And then in terms of job creation, you're looking at 250 million odd jobs through the private hospital groups, which comes to somewhat 1.6% of national employment. Essentially, the equivalent for every, I'm going to quote you in rand terms here, for every 100 rand of private hospital services delivered by private hospital groups, South Africa's GDP grew in 2017 by 123 rand. Private hospital groups' activities stimulated production of intermediate goods and services worth 7.7 billion. And for every one, yeah, there you go, I've covered that. But essentially, the groups in 2016-17 spent over 118 million in CSI initiatives. So there's a big social contribution going on there as well. that gives you some perspective of the private sector scale, which is in a relatively mature state here, and there's still gaps in the market, as we see coming through with new developments. Back to you, Shehzad.
So from a healthcare real estate valuation, this brings us to the third part of our presentation, in which Martin is going to talk about, why do we need to undertake healthcare real estate valuation and the challenges. I'll talk about the methodology and factors considered when applying the valuation methodology for healthcare real estate in particular.
Thanks, Shehzad. Okay, so I think, as is the case in most sectors, there are common reasons for wanting evaluation. So we've just highlighted a few here, but essentially you're looking at valuations for raising loan capital, bank debt. There's pre-listings, capital raisings. Obviously, the most common would be your annual year-end reporting, sale leaseback transactions, insurance values, and then obviously for transaction purposes and business combinations, mergers, and so on, acquisitions. Just moving on then to the approaches. These are internationally recognized valuation methods, the most common being for investment property, the income approach, which may well incorporate discounted cash flows covering the life of the lease covenants, or indeed break clauses in those cash flows to make assumptions on renewals and so on. But essentially, the valuer is likely to consider more than one approach in his valuation, and obviously the most elusive of all is to find reliable benchmarks. But there are benchmark indicators which do come through from various specialist consultancies, and so the comparable approach is always a reliable second benchmark to the income approach. We're also seeing the cost approach applied, certainly on relatively new developments, and indeed there may well be development leases coming through which are cost related even on the renewal clauses. The residual approach, a bit more difficult, a bit more subjective, where you're looking at the cost of the value of the completed development less the cost to develop, simply because it's so reliant on so many variable inputs, including obviously yield interpretations, exit yields, and rental data. What are the challenges in methodology? Well, it's not always a simple, clear triple net lease agreement. And so very often one has to consider looking carefully at the operating company performance, EBITDA figures, growth forecasts, and so on. And of course, each asset is more often than not different from the next one. So the asset uniqueness is always a big challenge. If there's special care facilities, high care, aftercare, how many theatres are there? How much of the hotel operation is independently run, whether it's radiology or pathology, and then invariably in Africa, it's such an opaque market that a lot of the time there's such a lack of comparables, and so one has to really dig deep with that, and often look outside the environment for those. And then obviously in Africa, there's very often a very big difference in the regulatory platform from one country to another, beginning, of course, with land rights. And we have so many different forms of land tenure systems which impact on the risk and ultimately the cost of development. And let's not forget the regulatory walls which go up for developments in the commercial sector. And very often your build outs can take a lot longer than they would outside of the continent. So yeah, those are many of the challenges. And obviously the most recent challenges is the impact of COVID. We've seen a revenue fall sharply within the private hospital sector because of COVID, and elective procedures have been postponed. Sure, they're being resumed currently, but still, it's going to take a few months for those values to return to pre-COVID levels. Shehzad, do you want to talk to the theoretical rent determination, or do you want me to cover that?
Sure. I can take it from here. So the thing is that the key question is that what is the approach to value healthcare assets then? And it's basically a variant of the income approach, and how we've termed it is the relief from rent method or the affordable rent method. It is what this is the value represents the rent savings the subject asset would generate on a present value basis if rented at an arm's length transaction from a market participant. So when we're considering rent as a principle, we need to ensure that the rent is such that it does not strain the financial resources of the operations of the entity. Otherwise, it will lead to financial strains and probably have a going concern issue on the operations of the hospital. So what is the affordable range? It is between a quarter and a third of the EBITDA. Is that what we believe should be affordable? And there's plenty of case laws to support, what is an affordable payment for another asset within which does not belong to the business and is critical in its operations. But the typical factors that result in the movement of the theoretical rent line between a quarter and a third is primarily, what is the where does the business sit on the life cycle of what is the physical condition of the asset? Is there any additional investment required to maintain the asset? And what's the growth potential in general? How we tackle this business is that we look at, we employ a team of healthcare experts, financial experts, and real estate experts to look at the valuation. And now in this slide, I'm going to try and explain what each of the three participants do and their role in this, in carrying out the real estate valuation for healthcare assets. So a healthcare expert, as on our team, is a medical doctor who actually does a survey from the healthcare perspective. He analyzes the demographic profile, the epidemic profile, and disease trends in the area, does an in-depth analysis of the sector, does primary research, gets insights from healthcare operators around the area, analyzes the current infrastructure, market trends and shifts and how they're moving. He reviews the healthcare services offered by the hospital itself and understands the hospital business plan and the basis of assumptions that have been used in creating the forecasts. So all that market knowledge going from top down can help translate directly to understanding the forecasts that the management is making. What that he tags team with the financial guys who have been in that meantime looking at the historical financial statements of the hospital. They've tried to normalize the earnings because there could be certain factors within the earnings that may cause a variation in the EBITDA. Normalize the non-recurring item normalize the earnings by removing non-recurring items and understanding the basis of assumptions that have been translated into the forecasts. And that forecast, based on that forecast, the theoretical rent line is, or the affordable rent line is backed out. And that is then handed over to the real estate expert who, whilst we are doing all this exercise, has done the survey of the real estate from the real estate perspective. He's walked around the entire site, has looked at it from a regulated perspective, and that rent line that we forwarded to him is then discounted at a market-driven discount and cap rate to arrive at the value of the hospital. So how all this comes together is in the following slide, where I'll be discussing how we move from the low end of the affordable rent range of a quarter to the highest end. What are the factors that we consider? So from an operational perspective, I'll be looking at the stage of the business life cycle, the services offered, financial performance, and accreditation available to the hospital. That gives me a lot of insights on the operational strength and viability of that hospital. The other items I'll be looking at would be the location in terms of is the hospital's price point fit the catchment area of the population, right? What is the level of competition in the area? Because that has an impact on the assumptions, growth assumptions of the hospital. And also, are there new healthcare facilities that are coming in the catchment area? That's going to be another issue that we will need to consider. The other thing is that we will also look at, the rate of insurance rejections, non-recurring items in the income statement, working capital cycle issues, because at times when a hospital is catering to government employees or the hospital is catering to some insurance companies and there's great delays in working capital, that strains the financial resources of the hospital. All these have an operational impact, and that would mean how much I'm able to move from up on my affordable rent line, as well as how much money I need to spend on maintaining the asset. From a yield perspective and from a pure valuation perspective, Marta's going to shed light on the other terms.
Yeah, I think it's important to point out that much time is often spent on stripping out the real property expenses and operating costs from those grey areas of facilities management, hospital management. It's really important to separate the two. If you're looking at an owner-occupied facility, it's one thing. If it's a lease agreement, the lease will generally guide you in separating business from property. So if it's owner-occupied, one looks for market practice models to know just how much of the property is going to shoulder the maintenance burden, because as you know, the specialist mechanical and electrical installations required by hospitals are enormous, and the cost is significant. And generally, that's an OPEX maintenance item, and certainly not a landlord item. Yeah, and I think once you've reached your NOI on the property itself, then obviously one looks to the age and life of the asset in terms of your discounted cash flows, etc. It's quite difficult to assess non-recurring capex into the longer cash flows for hospitals, and so the information given to you by the healthcare expert is quite critical on that, and obviously the hospital operator themselves. Yeah, so I think back to then, Shehzad, although we're looking now at yields, the next slide. Yeah, this is a bit of a tough one. What we've done is we've taken from the Africa report a sampling of pre-COVID yields across sort of SADC, West Africa and Southern Africa, just as a sampling for office, retail, residential and industrial. I hope it's coming through on the slide. But you can see there's a fair bit of correlation. Kenya's yields on residential are particularly aggressive, down at somewhere between 5.5%. If we look at the healthcare sector yields in South Africa, I think, and I'm just quoting the NOI in the integrated report from Growth Point, for example, last year I think it was 210 million on a cap value of 2.6, which suggested a yield of around 8.07% for that particular unlisted entity, but generally one's looking at yields of around 8.5% or less on average in South Africa. That's for the health sector. The situation is also, if you cut across Africa, one's got to be conscious of the dollar relationship with local currency valuations that can have a massive impact on the outcome, depending on the instruction or on the market, whether it is transacting in local currency or dollar or other currency. So that can also will also impact on your all risk yields, exit yields, and discount rates. Local inflation also comes into play if it's a local currency valuation, and we've seen the situation now in Zambia in the last month, quite a sharp value and inflation rising. So there's country risk to consider as well across Africa. It's quite a challenging environment to work in. Post-COVID, well, there's simply so much going on. I can really only relate the FTSE JSE. I mean, we've seen the listed property index 48.8% down on over 1 year, for example. At its worst point on 15 March, it was down 62%. The real estate investment trust, the rate environment in Africa hasn't escaped unscathed. We've seen portfolio values, share portfolios values coming down by as much as 30%. And there's likely to be a temporary suspension of dividends, even in the rate environment where distribution is a legal requirement. And I think we can expect a short-term reduction in asset values. I think there's a perception that market sentiment may have overreacted, but we're still going on that upward curve with COVID. So we don't believe we reached the peak. Certainly the more testing coverage there is, the more the numbers are revealed. So I think though the rate sector has shown resilience in the past. If we compare where it is now to post-2008 levels, where it came through and returned back to its previous highs, I think that's likely the direction it's going to go. The question is how long, and it also assumes that the world is not changed forever, of course. So, yeah, back to you, Shazad.
Sorry, so what we try to do here is that we try to look at the healthcare sector as, what we try to do is that we try to look at the healthcare sector from a developed market perspective as well, especially after COVID. And what we did was that we looked at the yields and the yield movement from May 2019 to May 2020. And we looked at all the way from high street to offices. And we saw that in general, there was negative sentiment, especially because of Brexit, the heat wave, and COVID-19, and all these other factors that were there. But what was interesting to understand and know from this was that the market sentiment for specialist sectors such as healthcare, student housing, and prime distribution was actually stable. This effectively presents a strong business case to invest in healthcare, because what we've seen is that, like for example, in Africa, we see that because of the population growth, because of the growing middle class population, because of increased insurance and also financial activity, the sector will grow. But we're talking about a country like the UK, which has a strong NHS system and it's a developed nation. But even over here, the healthcare sector has shown resilience and has proved itself to be a low beta stock, which is or low risk stock or low risk investment option, that can and should be explored in the future. That brings an end to our presentation. I'll leave it to Tilda to take it to give us a little roundup.
Okay. Thank you very much, Shazad and Martin. I think it has been quite an insightful and informative session for me. And thank you for the trip around the world, even in terms of yields. And I think the main takeaway is we recognize that healthcare is an emerging sector, especially for Africa. But then the demographics tell a really positive story. And if you look at the sort of activity that has been going on in the market, there has definitely been a trickle down of activity, and we expect that this will gain momentum moving forward. And so that is why for Knight Frank, this is a key sector for us, and that is why we're doing this webinar today. So we have some bit of time to look at the questions. We have had quite a lot of questions, so bear with me if your question is not addressed, but always feel free to reach out to us. But I will start with the initial questions. So this one I will address to Shazad, who can pass it on to somebody else. And the first one is, what is your assessment and opinion of the future of healthcare investment in Nigeria and Ghana in the short and medium term?
So like I said, well, thank you very much. I think, so in both countries, we're seeing that there is a great population growth momentum that is there. We see that insurance, for example, I think in Nigeria is about 3% in terms of penetration. And we see that in both these countries, the middle class is growing. What we need to do is we need to create and stimulate investment within the affordable healthcare segment, especially in the primary care sector, because it is here that will help us grow into the secondary and tertiary elements as well within the healthcare space. And I mean, we don't need to worry about 100% focusing with the government, but from a pure investment play, we should be focusing on affordable care, and because that is a scalable model across the continent and across the cities, and the more scale and the more scale we have, and the more brand name or better brand name that we can establish for ourselves, it will be better. Either we do it from in-house or from in-house brands and take them forward as a private equity play, or we can try and introduce an international operator that has already got a tried and tested model for affordable and quality healthcare. I mean, this is how I look at the market going forward.
Another question is, earlier on you mentioned that a 100-bed hospital would create 600 jobs. So the question is that based on UN data, or what is that based on?
This is based on a general or multidisciplinary hospital. It is not based on a center of excellence model, by the way. It is based on a multidisciplinary hospital whereby you would have a certain set of prereq healthcare services and planning based on international standards of staffing to bed ratio, and staffing to so staffing in terms of outpatient clinics that convert into inpatient beds, and staffing the inpatient beds as well. So it's a complete composition of that. So it not only covers doctors, it covers allied healthcare professionals, as well as management staff to support the entire operation.
This is just taking into consideration that this is the least bit of staffing required for a 100-bed hospital. In an ideal scenario, they may require more than this. So a 600-bed hospital essentially would require about, a 100-bed hospital would require about a 600 medical workforce, but this is keeping it at the lower end. When the occupancy keeps increasing, the numbers actually keeps going up further.
But that was Dr. Girish, who was a medical practitioner on providing his inputs. I don't think we can still see him.
Yes. Okay. The other question is it possible, of course, in the wake of the COVID-19 pandemic, you talked about valuation. So is it possible to carry out a virtual valuation inspection of healthcare facilities in particular and other properties? I think healthcare.
Well, the thing is that from my experience here in the Middle East, I know that the local government has allowed and provided permission for us to virtually visit any facility to undertake a real estate valuation. But I would then ask Martin and potentially other members of our Knight Frank team to be able to give their insight on their particular country and how the regulations are permitted. Otherwise, virtually, at least here in Dubai, we've seen, and our team has undertaken valuations based on a virtual tour of the real estate asset. Martin, do you want to shed some light on this, please?
Yeah, sure, Shazad. I think in answer to this question, every country is likely to be different, and I can only really convey what ours is. Tilda will have sent through a fairly regular dashboard on the various in-country regulations during the lockdown measures, which is quite useful and I'm sure available to those attending. But from South Africa's point of view, we've got 5 levels, 5 being complete lockdown and curfew. We're now moved out of level 4, we're in level 3. And for professional services, these became more mobile, and one was able to carry out property inspections during level 4, in fact, with permits and obviously ensuring that both your client and yourselves were completely PPE compliant with masks, disinfectant, social distancing, etc. So level 3, there's an easing of that. Still, from a mobility point of view, it's more a case of one can now move between districts and provinces. There's no curfew in operation, which makes quite a difference. But still, there are a number of businesses in the non-essential category which are not allowed to trade, including salons, restaurants, etc. And we're hoping an announcement to come through this week, which will allow those businesses to get back into business. So, yeah, I'd be interested to know what the regulations look like elsewhere in Africa currently.
So the other question for Martin, I think, has been the yields that you were talking about. In what currency are they in? The yields that you highlighted.
These are taken from dollar-based transactions with dollar-based revenues and local currency operating costs.
Okay. The other question that I have that I will direct to our country heads in charge of Uganda, Lusaka, Zambia, and Nigeria is the yields that Martin has portrayed across the different sectors as for Lusaka and Kampala as higher than Lagos. So the question is, what is the reasoning, what is the underlying cause behind the higher yields in Lusaka and Kampala as compared to Lagos?
I think I'm not sure if Tim Ware from Zambia is on the call, but I think Lusaka really, in terms of country risk, has moved up quite sharply in the last 6 to 12 months. And even more recently, inflation has been accelerating. The currency devaluation has also had an impact. And so one has seen movements between local currency rentals and dollar-based rentals within properties, which the more you're moving towards a local currency rental, you're immediately going to see your yield moving upwards, and I think this is what's been happening in Zambia in recent months. I'm not sure what the position is in Kampala, but I see Tim up there. Perhaps Tim, you'd like to say something.
Yeah, thanks, Martin. Yeah, I think you've hit the nail on the head with the currency issues that we have here, where we've had a devaluation, particularly in the last few months. 6 to 9 months, we've had a currency devaluation of 30%. And then we had some stability before that. And then again, we had some major movement declining on our currency. So there is a lot of discussion going on between landlord and tenants at the moment regarding rental payments, with a lot of tenants looking at this kwacha issue and the ability to pay rent in kwacha versus the dollar. And that has maintained our yields at those sort of levels. We've also got some oversupply in some of our market too. So in particular for the offices and retail, with a significant construction over the last 2 to 5 years, that's put pressure on the market. So there's a little bit of adjustment going on there. Thank you.
Thank you, Tim. Judy, I see you're there. Would you be prepared to comment particularly on the retail and industrial sector yields, which are the highest, in fact, I think, at around 12.5%?
Yes, thanks, Martin. I think similarly to Tim, our currency has been unstable over the last 6 months, and it's actually devalued by quite a bit, by about 30% year on year. I think we're also one of the only countries in Africa that was fully locked down over the last 3 months. And this has taken its toll on rentals and occupancies and trading, particularly for retail. Matter of fact, retail only opened up for trade 2 weeks ago, and we're still seeing a lot of stress on the retailers as well as the traders as well, and trying to enforce the social distancing measures in our retail centers and many retail centers across the city has had an impact on trade, and retailers haven't been able to restock fully or to get back into trading fully, and they also have seen quite a reduction in foot traffic numbers to the retail centers and struggling rentals across the board. And the same thing within the industrial sector. We've seen disruptions to the supply chain, which has led to truckloads of goods and services being stuck at the borders as the truck drivers are being tested. This has caused delays in the import of goods and therefore reduced demand for warehousing space. And also, again, because of the social distancing measures that are being put in place, we're seeing a lot of the logistics and warehousing and storage properties lying empty and or terminations being called in, which has impacted on the yields and the rentals as well.
So Judy, just in Uganda then, the lockdown regulations, if we're looking at retail, what components of retail have been allowed to continue trading? Presumably you've got a regulated essential, non-essential service grouping there, or not?
Correct. The essential services were really mainly food, supermarkets, pharmacies, and I think that was about it. Just the supermarkets and pharmacies and restaurants, but only for takeaway services, but not for sit-down meals. Everything else was locked down fully.
And has there been a continuation of online shopping or a spike in online shopping there?
No, I wouldn't really say it's been online shopping. It's been more of delivery services for food and telemedicines and essential services, but not so much online shopping, as a lot of the stores where the services and the goods could have been procured from were also locked down. So it's been more online deliveries for food and essential services like the telemedicine.
Yeah, so same as here.
There's a question for Ben on the Kenyan yields, and I think Ben can handle that along with on the yield breakdown per sectors. Is it a breakdown or just an overall yield figure in the sector? And also if the Kenyan team would be available to take up a feasibility study for a hospital in Kisumu.
Yeah, certainly. The study in Kpis we can definitely do once we are able to move around. At the moment, Kenya hasn't been in lockdown. We haven't seen a lockdown, but what we have seen are particular parts of Kenya have been in containment. So those are the major hubs that have been COVID-19 hotspots. So Nairobi has been in containment for 30 days. That was extended for a further 30 days, which is due to end the end of this month. So until that time, we can't actually get out of Nairobi. But following that, we would definitely be able to do a feasibility study, particularly with partnering with our colleagues in the Middle East who are healthcare experts, and of course our knowledge of property on the ground. Definitely we'll be able to do that. That question has already been answered, and the person who asked it will be reaching out to me via email. So that's great. In terms of the yields, yeah, they are blended yields, and I think that the yields do differ within sectors depending not just on, for instance, in residential, not just on whether you're looking at high end and low end, as the person who asked the question alluded to, but also single occupancy and multiple occupancy as well. And of course, you've got economies of scale with multiple occupancies, which affects the yield. So these are somewhat blended when we rather oversimplify it in terms of looking at it as sector by sector. So residential, you could certainly break down. Retail, to some extent, you could break down, and commercial as well. We can give more information in relation to specific yields to specific people if they require further information.
Thank you, Ben. Frank, would you like to comment on the Lagos yields?
Okay. Thank you, Tilda. The impact of COVID in Nigeria is quite frightening. The spike is going up every other day. The major investment now, the yield, is in the warehousing. The demand of warehousing for storage facilities is quite high, and people are requesting for warehousing. But for commercial offices and residential, the impact is quite felt in the commercial, because most of the foreign investors, most of the multinationals, most of them have been moved out. Most of the offices are not yet on. And with the kind of protocol on now that less than 40% of occupancy in various offices, people are not opening up yet in the offices. And we're going to find a bit of lower yields in commercial offices, especially with buildings in Nigeria, especially in Lagos. The oil companies are still on lockdown. None of them are open. Shell is not on. Mobil is not on. Total is not on. And some of the services companies associated with them are still working remotely from home. So it's affecting the yields on the commercial offices, especially the grade A offices. But in the residentials, it's either here or there, especially the luxury apartments is still being held too. The level of rents are quite stagnant for now, because our currency is being devalued by itself. The rates compared to the dollar rates today is almost about 400 and something to $1. So where the business is now is the warehouses, because of the online shopping, and people want to store their goods. The income as well, making a lot of transactions on the warehouses. The retail shops are still on lockdown as well. There's no much activities on the retail outlet in Nigeria now for now, especially in Lagos, Port Harcourt, and Abuja. So it's quite a big impact on them. Thank you.
Okay, thank you, Frank. And I think for the final question, I will direct this to Shazad and Dr. Girish. What are the key performance metrics used to review performance of healthcare operators? And are there benchmark levels for Africa? And how do you measure, in terms of development, how do you measure the optimum bed size for hospital development?
And this is a very, let's just say, good question. What we typically want to do is like we initially alluded to at the very, very beginning, that, every healthcare asset is different. And what we would effectively, when we are valuing a healthcare facility or a real estate project in a particular area, that assets and the revenue potential of that asset is determined based on its operator or the occupier. So for us to look at the operational performance of that that entity is critical, and that's going to be our first step. And as far as giving it a comparison between other real estate or let's say other hospitals in the area, we could potentially do that based on certain KPIs, and which we've developed our repository over time, looking at different hospitals within the region over here. And also we could look at the stock market and the financial statements of different hospitals within the different stock markets, and understand the operational performance, just to understand how far this hospital is from there, from our benchmark. But nonetheless, the value of the real estate asset would technically be reliant on the operational performance of this particular asset. Unless we find that the certain expenses are being overburdened, or there's a peculiar way that this thing is being run, whereby we might have to rely solely on comparables. Otherwise, doing a proper due diligence on the financial statements, we'll be able to arrive at what the normalized earnings would be, and that's what we would use as our starting point, because that is the risk of operating that real estate and having a long-term tenant with that operational model in there, which is why it's so critical that we do an analysis before having, for newer projects, it's critical to understand what the business plan of that new hospital is, what is the benchmark and KPIs that that hospital is going to be committing itself to before we have them on board. But if it's in the existing hospital and has been running over time, we would have to look at their existing performance, and also have to have a bearing on exactly how the other hospitals are performing in the area, to understand what would be the occupancy levels and what are the services that are in demand. And all that would culminate into the value or the rent or the sustainable EBITDA of that organization, and what the affordable rent would be. I hope I've addressed your question.
And just to add to that, in terms of identifying the right bed capacity for a hospital, we probably look at the macro market as terms of the city level, and then we'll also identify the immediate catchment and try and then derive what sort of bed capacity should be there and what are the key specialties that are going to contribute into that bed capacity.
Okay. Thank you very much. Thank you to all our panelists, to you who delved into our webinar, and to all our country heads, and to Shazad Martin for the presentation. This is all the time that we had to take in the questions. Of course, there are way more questions that we have not answered. I have shared my email in the chat box, so please, for any pressing question, feel free to email me, and we will try our best to answer your question. For now, thank you very much for dialing into our webinar, and of course, as Knight Frank, we remain your partners in property, and for any questions, we are accessible for further conversations. Thank you very much, and have a lovely evening. Thank you.
Thank you.